let me know that as well. Yeah, welcome to you all. Let me share the screen with you. We've got a heck of a lot to cover in all of this, so we want to start straight away. And let me know you can hear me and that you can see me. Like I said, let me know your location, where you're from, and all of those things. Don't forget, this is the public one. So if you're already a client of mine, you don't need to watch this because I've given you the private one on the private Telegram channel earlier today. Okay, so just want to welcome you all as you come into the chat room. Fred, Kanesh, Dennis, John, David, Tim, Chris, Hayes, Ravi, Carwin, David, and everyone else. Let me know that you can indeed see and hear me loud and clear and put it into that chat room. Good. Welcome, Swansea, into the room. Now, as I said, it's the public one. The clients have got their private one with all the details on the private channel. So if you haven't visited my Campaign for a Million to teach a million people how to be better investors, please do visit campaignforamillion.com. Remember, this isn't solicitation to buy or sell any specific individual security, and it's not financial advice because I'm not speaking to you one-to-one in any event. It's broad education information about the markets. Speaking of which, where are we on all of these? Well, Microsoft, you're paying $24 for every future dollar of profit in Microsoft. How do you decide if that's cheap or not, and whether it's even relevant? Well, one of the problems with just looking at valuations is Microsoft's more expensive than Nvidia, but you might say, that's incredible. That means Nvidia is dirt cheap. You're paying $17 for every future dollar of profit, whereas Citibank, you're only paying $7. Well, valuation aren't the only thing that moves stock prices. In fact, yes, indeed, that does look ridiculously cheap, as do all the banks. Does that mean we just go in and buy them? No. We might be able to get them at a cheaper price, and we've got to think about future growth. In other words, what moves stock prices is not valuation alone, which is the only thing you're seeing here. Growth does income. This is why wealth managers and IFAs and fund managers are so usually useless, because they will try and sell you a value fund, which will only look at one set of criteria, or they will focus on a certain geography, or they will focus, like I said, a style like value, growth, income, a geography, or a theme, only AI. So they're going around with their hands tied behind their back, whereas surely we want to try and pick from what's the best of out there. And how do we judge what's best? Well, we can't do it simply by looking at valuation alone. How do we decide if Eli Lilly on a valuation of 27 is good, bad, or ugly? You might agree that Nvidia is a better bet over the next 10 years than JP Morgan. So we're going to dive deeper into these, and I'm going to show you some charts of these and tell you what I like, what I don't like, and also remove, as I've just tried to do there, some of the misconceptions, popular misconceptions that people have from magazines and from their wealth managers and IFAs about the markets. Misconceptions which they promote because it serves their own interests, such as, well, person with a hammer sees everything as a nail. Well, a person with a value fund sees everything as, well, hey, you should just look at value. Forget growth and dividends and past performance and volatility. No, just look at value. So we're going to remove some of those misconceptions that have been fed into you as well. Misconceptions which I've addressed in my 200-odd Financial Times columns, my 18 books and the like. It's going to be a busy week the next 7 days. This is just what's happened today in terms of earnings, and you've got some big names. We're in earnings season. Continuing today, AMC means after market close, of course. A whole bunch of stuff coming on during the course of this webinar. And then tomorrow, you've got biggies like Alphabet. What's it essentially going to mean? Well, I'm going to show you whether or not we're near the bottom of these falls. And I'll show you that in specific charts. Would any of these earnings make us more likely to be near the bottom? I don't know. I honestly don't know. The best guess that I could give you is, even if these earnings were amazing, the problem's going to be the market might say, well, tariff uncertainty, who knows what the future holds. Even if all these earnings were amazing and the company said the tariffs are simply not going to affect us, who's going to believe them anyway? So I think these earnings will not actually be that significant in terms of telling us whether we've hit the bottom of the market. They will be significant in telling us whether we've got good quality companies which are underpriced and what we should pick up. And I'm going to tell you where I think I'm going to make my money from. I don't need to look at all of these. I don't need to try and make it from each of these. For the simple reason, you only need a handful. Out of 10,000 equities which are out there, I probably need a handful to focus on. I certainly don't think I need bazillions out there to look at on this. Okay. Hi, Chetan. How are you? And I'm going to pull something up on screen as well, because I'm going to show people that in actual fact, one of the things that we do and why we do it, so I'll just share my screen again. Here we go, share. Okay, the reason we look through 9 or 10,000 equities, and none of these meet my criteria. So for anybody who's a client here, Chetan, I know you are, I'm not giving away any of the secrets. Don't worry, you guys get to see that button, the filtered one. The reason we need to go through 10,000 is because, as Warren Buffett's discovered, there are very few companies worth putting your money in. Otherwise, it'd be very easy for him to deploy his cash. There are very few companies which are relatively undervalued, give good growth, generate lots of cash. Don't forget, companies only have 3 sets of accounts: P&L, balance sheet, cash flow. All companies anywhere in the world, I don't know, for the last 1,000 years, whenever double entry bookkeeping was invented, Ravi, you'll tell me. So we're looking at those 3 things across all of the companies. And we're also looking at one other thing that they have, which is very important, is their price, where people are willing to put their money. And we want to see ones which have had a consistently high return with low downside volatility. And quite frankly, there are very few which meet our criteria. And we need all of these to be green, because one thing that we don't want to happen is buy something and then have some kind of regret or sleepless nights. And I'm going to come to that later on, because we're buying businesses. We're buying businesses for our pension, our children's inheritance, and we want to bloody well make sure we've done all the damn due diligence we possibly can. Otherwise, we're going to have our kids looking up at us going, well, you're rubbish, aren't you, Dad? Or Mum, okay? And my number one job for clients is this column, actually, I discovered. I thought it was this one. This one's the easy one, the first 5. I just click filtered. I soon discovered my number one job is actually making sure that their risk appetite fits the volatility of the portfolio that either we put together for them or they select from the ingredients. This is like the ingredients, the raw ingredients of baking a cake. Sometimes we give them the cake and say, look, I think this is suited to you. And the biggest problem is they often don't know themselves what their appetite is. They always overshoot and overestimate. If you tell them from 0 to 10, what's your risk appetite? Vast majority will say 7, they're actually a 5. 5s are actually 3s. Okay, and so I'm going to show you and explain to you what these numbers mean and why getting that right is so important, because otherwise you're going to panic and exit too early out of good quality companies because you simply don't understand that you're holding on to gold and you let it go. How often does that happen in life? So very often. Okay, and I'm going to show you how, to begin with, you never want to hold something which is rubbish anyway. Okay, so if only what you're left with is good, the only circumstances in which you might want to exit it sooner than a very long time frame is if you'd already planned on your strategy, right, we're getting out at a certain stop loss. So we'll go into all of that later on. By the way, all these are coming up as well. Can you believe it? All these as well. On that, Raheem, I will answer all your questions. Hi, Jeff. There are 2 Jeffs. I'm in Malaga still, as well as Cambridge. Hi, Jeffrey. As well, right? So there's a lot of these earnings, and like I said, that doesn't mean there's a lot of opportunities. And we're not going to chase our tails. We're going to have a plan and a process. And I'm going to tell you what I like at the moment. So I'll show you some ready-made cakes. I'll also give you some ingredients of how you decide whether something's good or bad and remove indecision so you can spend more time smelling the roses. I first want to start off with some of the exchange-traded funds, some of the really safe ones historically. You'll sometimes see on social media people going, oh, just buy the world ETF and you'll be fine. Okay, well, let's have a look at that. Okay, well, if buy you'll be fine means that for 2.5 years you'll get 0 returns, in actual fact, at the time wrong, for 2 years you'll make no money, then that's right, you'll be fine. If you've got 2 years mean nothing to you. It also means that if you lose, what is that, 25% of your money in the space of a month, and you're okay with it, That's fine. And that you may well be okay with, as long as you are well aware that the drawdown depth and duration to recovery is of a certain height and size. Anyway, for me, I'm not getting into this. There might come a time when, if not for me, for an aunt or somebody else, I'll tell them to buy this. This is the safer end, the 4% volatility end. And this is probably as safe as it gets. Not because it keeps going up, but because the volatility we know happens to be slightly over 4%, which is the low end. We'll be looking at this. We'll simply be looking, and what this is, by the way, is just looking at medium and short-term prices. If short-term prices and medium-term prices are both going in the same direction, then it tends to suggest I don't want to be buying. And that's all that is. You could put it into simpler terms of pattern recognition and say, when this period is like this, I just don't want to be in it because I'm holding. Unless my plan was, I'm just going to hold this for 20 years, in which case a few months here or there, or even 2 years makes no difference. If you're planning to hold something for 20 years, then 2 years makes no difference. Okay. If you're planning to hold it for shorter than that, then yeah, you better keep an eye on it. So at the moment, while some of these are great, and this 25% drop, I am self-assured, will return to its all-time highs at some point in the future and give me my 33% return on a low volatility, ain't going to happen until this starts rising. So it's not going to happen yet, but my 33% with very low downside volatility is going to come from this as one example. Not yet, nowhere near yet. So clients of mine, you'll be told when I get into it, or I tell a family member who wants lower volatility, now's the time to get in. But it certainly isn't now. I don't care what the politics and economics of the world is. And you know, when they talk about geoeconomics and geopolitics, whilst I've got a master's degree in politics and economics, and I used to work in the US Congress, and I've worked in the UK Parliament, and I can tell you none of that means anything when it comes to investing. The most important thing I learned from my master's degree in politics and economics and working in Congress was none of it is relevant to investing. All right. So it taught me not to make the mistake everybody else does in all the magazines and everywhere else, which is look at economics. The only other person I know who's openly stated that, and I found a video from him just recently, was Warren Buffett, who said, I've never looked at the macroeconomy when looking at buying a stock. Got it? The video, he said it, his very first stock was bought in 1943. He said, if I looked at the macroeconomy, I wouldn't have bloody bought a stock in 1943, would I now? Now, that's going to be one. In future, not now, this will be one of the others. So any of you who are my clients, don't worry, I'm not giving away the crown jewels, because it's when, which will be important. Now, for those of you on social media who go, well, you just buy it, you just stay on forever. That's fine if you want to stay on forever and you don't mind having, like I said, couple of years of 0% growth. For me, basically, I avoid those scenarios when short and medium term prices are falling, and that's what's happening right now. Now, look at how quickly it's happened. This is pretty much unprecedented. That didn't even happen during COVID, those kind of falls. I don't care. Does that mean it's something different? Is it Trump? I do not care what the noise is. I care where people are putting their money. For all the people talking about politics and economics, and I can bore the pants off anybody talking about politics and economics if you so wish, what I care about, and when people are truthful, it's not what they say, it's where they put their bloody money. It's always been the case. If you want to know if somebody's telling the truth, tell them to put some money behind it. And they're not putting their money in here, they're taking it out at the moment. And as long as that keeps falling, then they're going to be taking it out. And as long as they're taking it out, I don't want to be getting in. And I won't get in too early, because when these things are falling, okay, I don't know if it's going to keep falling. I will always inevitably be getting in late. For those of you who say, oh, but that's lagging, all those multi-billion-dollar hedge funds like Winton Capital, who follow exactly the same strategy, they get in lagging because there's a higher probability there. We don't have a crystal ball. We're not trying to get bottoms or tops of markets. Anybody who tells you they are is probably on social media and doesn't do it for real. All right, bottoms and tops, no. Witchcraft makes good for writing magazine columns, but those people are called journalists, right? We will be lagging. We will be getting in late. Okay, you've only got two options. Either you're going to be getting in while it's falling, in which case you don't know how much further it's going to fall and you're screwed. You're trying to catch a falling knife, as they say, or you're going to get in once it started rising a bit. And even then, there's still a probability it could droop off. But at least there, you've got a 50-50 chance of it going up. Here, there's a greater probability of it falling than rising. And that's if the markets are efficient. If they're not, then you've got a 60-40 chance, 70-30, who knows? But I'd rather be getting in late than getting in early and regretting I was out. Okay, so the mistake retail clients make, guess what it is? Can't bloody sit still, impatience, get in early, and then they crash and burn. So this, which has fallen from 4,000 to, what is that, 3.3, okay, 700 off 440, 700 off 4,000, that's going to give me a 25% return at some point. Not yet. I'm not going to buy it yet because it might get even cheaper, and I'm being cheap. I'd rather wait. Now, it might be that it drops, comes back, and I end up buying at that price that could have got today anyway. Well, so be it. Okay, but I'd rather buy later at the same price as today than buy early and then see it drop, have buyer's remorse, and go up. That's the mindset. It's not my mindset. When I wrote Mind of a Trader, Lessons in Trading Strategy from the World's Leading Traders, this on a trading basis was applied. We're talking about investing. They applied similar philosophy on the trading side as well. This will be another one where the money will be made. Not at the moment. You get in early, you're going to get your fingers burnt. You're going to possibly even be stuck for 2 years in it. How long are these falls going to last? I do not know. I do not care. I do not estimate. I do not worry about things I do not need to worry about. Whenever this happens and this starts rising, whenever it happens, and it might give a false dawn first before it goes up, I do not know. I will keep an eye on it. I will let my clients know. And at that point, let's say it's roughly around the same price, 9, and it goes back up to 12, well, we'll have made a 33% return. Whenever that happens, I do not know when, I do not care. Journalists care. When I was doing my Bloomberg TV show, we would happily speculate and gamble about when and what for and predictions and crystal balls. When you are investing with real money, you patiently wait and you try to decide on the least number of things you need to worry about. And the least number of things I need to worry about is when's that rising. That is it. I don't need to worry about Donald Trump. I don't need to worry about his tweets. I don't need to worry about any of those things. The moment you start worrying about all those other things, you are gambling because you are adding increased levels of uncertainty into your decision making, which will lead to confusion, lead to you not having a plan, and lead to you messing things up. Okay. Jeffrey and Jeff, I will come into this, and you can dollar cost average if you're in a rush, Kieran. There's nothing wrong with dollar cost averaging. There's some recent academic research, I assume you've read it, which shows that in actual fact, most of the time it's not worth doing and you'll be worse off doing it. So it's, again, one of those things which people have heard of through magazines and journalist articles, but they haven't read the latest academic research, which has actually gone into what would have actually happened if you dollar cost averaged. After all, like with all of this, I mean, I prefer taking a scientific approach. I prefer looking at the data and saying, well, if we take the data, what actually would have happened? So you take the data. I've written about this in the FT as well. So you take the data and you say, well, obviously, you've got tons of data. Let's see what would have happened if you actually did that across various periods. And of course, there's a minority of times when it would have been better for you to do that. Majority of times, it wasn't. You can, if you Google it, there's some recent research where the academics went through very many periods. So great. Read an article, pick up a tiny bit of knowledge, and a little knowledge is a dangerous thing. But you don't look at all the literature on it and you find, oh shit, maybe I should have bothered, given that it's my money that I'm talking about, to look into more detail. So you absolutely can. If you're in a rush, it's suboptimal, but happy to do so. I don't want to. Why would I want a dollar cost average when I can get something cheaper? If I go to the market today and I figure that, you know what, based on what's happened on the data, probably will repeat itself, not guaranteed to, time and time and time and time again, then I'm likely not to pick this up for 7,000. I may be able to pick it up for 6,500. Why the hell would I go out and buy some at 7,000 anyway? You're giving truth to the point Warren Buffett made, which is the market is a great mechanism for moving money from the impatient to the patient. You dollar cost average because you're impatient. You can't be asked waiting. Fine. So you're giving money to the ones who are more patient and will wait and get in a little bit cheaper. But you can. It's better than at least going in too early. At least it's not as bad as that. It's to prevent you from spending all your money in the wrong place at the wrong time. Dollar cost averaging. So it's better than private investors not doing it at all and getting in just so early and then impatiently panicking. But we'll discuss some of that in a second. So where are we on the market so far? The S&P's down nearly 10%. Year to date, good. Because there's some bargains. I mean, if it's going to fall, I'd rather it didn't fall, but if it falls, I'd rather take the Warren Buffett approach, which is fantastic. I must be getting some cheap companies coming along. And we'll have a look at some of them. Some of them are falling because they're not cheap. They're just, as again, to quote Buffett, when the tide goes out, you see who's been swimming without any shorts on it, which some companies are just rubbish. So they've fallen. Equally, it doesn't mean the ones which are up here are the winners, because they might be trading on momentum. They might be overvalued. And I don't know, there was a meme stock or there was a tweet done about it. So we still want to be diligent in our assessment. We want to be, because it's our money, we want to make sure that do they tick all the boxes. That doesn't mean that some of these really bad companies can't go up. Hey, get Donald Trump to do a tweet, anything can go up. Get somebody on Reddit to do a message or do a post, you can get a meme stock. My point is, we're only looking for the ones for our pension. We're very focused. We're only looking for the ones for our pension, which tick all the boxes. Even then, they're not guaranteed to go up. So if you're looking for a guarantee of things going up, or if you're looking for a universal theory which will predict the price movements of every single stock, then this isn't the place. We're only looking for the ones for our pension. Okay, are we ticking enough boxes so that we haven't made any stupid mistakes? That's all. And we still can't guarantee the future because, very obvious reason, particularly now's a good time to explain it, Trump might do a tweet. The point being, there are X factors which cannot be put into Excel spreadsheets. Does that mean you should just ignore valuation and growth and dividend yields and balance sheets and cash flow statements and historic performance? And if a company's been performing well consistently time after time after time, should you ignore all those things? Probably not. Whilst they can't guarantee the future, probably is a good guide. Not a perfect guide, but a good enough guide to give us enough of a return. I'll show you some model portfolios we've made based upon those principles. Where did we get those principles from? Actually, really simple. For those who've been on my webinars before, value growth income from 3 economists that I wrote about in my various books who went on to win the Nobel Prize in Economics, Daniel Kahneman, Richard Thaler, Eugene Fama. Croakey from Goldman Sachs Wealth Management. When I set up the hedge fund, I was lucky enough to have a lunch with Jim O'Neill. His team presented about Croakey. I stole the idea. Cash return on capital invested. Companies in the top 25% by cash return on capital invested, generally as a basket, produce 30% per annum. Okay, not every basket every year, because financial crisis, nobody got 30, and not every stock in the basket. So all I know is I need to tick that box green, but it's not enough. I also want the companies to be undervalued and growing as well. This from the hedge fund industry, trend following. Trends tend to persist. Ample research on that done by the likes of Winton Capital, AHL, Citibank as well, actually, Aspect, amongst others. JW Henry, another trend following hedge fund, they own Liverpool. He's rich enough to own Liverpool. D.E. Shaw, where Jeff Bezos used to work. Okay, a lot of their funds are trend following as well. So we knew we had to tick that box. Okay, so getting back to the markets. Past week, okay, they did well because they came up with a fat pill. Does that mean I buy into it? No, that's noise. That's just noise. I mean, that's just, if I'm going to go on stories and narratives, then that's trading. Feel free. Private investors love trading. Private investors think that their pension is Vegas. Okay, they behave as if their pension is like Las Vegas, and they will roll the dice on every little story. They will read something in a magazine from a journalist and say, hey, you know what? Let's bet the children's inheritance on this, or our old age on this. It is incredible. That is exactly what private investors, retail clients are like. Okay, so past week was this. What does it mean? Absolutely nothing. Without knowing any more, it absolutely means nothing. But if you show that to a bunch of private investors, they'll come up with a whole load of investment strategies based not on data, very limited data, 1 week, not on any hypothesis they've tested. They'll just roll the dice on it. It's incredible. Okay, that's why Vegas does so well. Past year, this is how the market's done. Some surprises. I didn't realize Tesla's up 60% over the last year. Walmart's up 60, Costco 37, Coca-Cola 25, Apple 20%. Oracle's up about 3% today alone, but 9% over the past year. Palantir 344%, very popular on social media, but as I'll show you a little bit later, somewhat overbought. Not one I'd want to buy right now. If you already own it, you've got 3 decisions: buy, hold, or sell. Would I buy it now? No, because it's overbought. And we're in a daddy bear with the broader market, so I don't really want to buy. Hold, yes, unless if it drops X%, sell Y% based on your risk appetite. So if it drops, say 10% based on your risk appetite, you might sell 0 to 100%, because depending on what your appetite is, because you don't know the future, so you might as well base it on your appetite, and that's when the sell decision would be made. Okay, so we're going to look at some of these, and we know there's returns to be made. I mean, you know, that's even after the market falls. Look at how much green there is over the past 12 months. So we know there's money out there. We know our children's inheritance is in here somewhere, because the numbers are just so big. So let's have a deep dive into some of these. And worst case, that's just 1 year. Worst case, if you manage to get a bit of a turkey, hey, you could always extend it over 2 or 3 years, because again, if the company's financially sound, you'll make your annualized return over a longer period of time as well. Roger, no, I'm not. For the same reason I wasn't in 1945, 52, 55, 56, 61, 63, 71, 73, 74, 76, 79, 80, 87, 90, 97, 01, 2000 for that matter, 2007, 8, 2018, 2020, 2022. Do I need to go on? Or for that matter, 1870. So no, I'm not worried about that. Year-to-date performance. I gave a presentation in the United States about a week ago where I looked at the data on R&D research, venture capital industry, the patents being issued, a whole bunch of measures on what tends to lead to successful feeding into investments and IPOs and companies like this, and what leads to success in nation states. And it's amazing how far ahead the American monopoly is on wealth creation compared to any other nation. It doesn't mean others can't do well, just as, you know, you could create a search engine tomorrow and you might make enough money as well. Doesn't mean there's only one Google, but they're so far ahead that I think I'll be fine with that market. Well, me and Warren. Year-to-date performance, not as good, but these are where the opportunities are going to come later on. Not right now. I need them to get out of that slump first, but that's going to give me 25%. Well, actually, it's going to give me 50% returns because I always do 2 times leverage on what I call my quality 5. So that's 50%. That's 50% when it goes back to where it was and at the start of the year. But I'm not getting in yet because I think I can get it deeper, and I'm a bit tight-fisted on those. So again, like Warren, I get excited about these falls. When will I get in? Well, I've described the image already. I'll show you some more later on. So that'll definitely be one. I suspect that's a more difficult one to call because it's overbought and still so. So unless it falls more, it might be that I never get into Broadcom. NVIDIA definitely will be another one. So will Meta and Alphabet. They'll all be ones that I'll be doing the 2 times leverage on. So doubling up on, 20 becomes 25% return. So that'll be a 50 as well. So these 3 will definitely be 50s, but not yet. And they have been in the past, 2023, 2024. After 2022, I told cash like I'm holding cash now. Did I know 2024 was, this year, 2025 was going to be a down year? No, I didn't know 2022 was going to be a down year for the market either. I didn't know this was going to be a down year. Did I know in 2022 at the start that I'd be holding cash? No, until I had to hold cash. Similarly, this year, I didn't know I'd end up holding cash. But I'll show you why, because I don't have an opinion on the markets. The computer has an opinion. And when the computer told me, sorry, fire alarm, I thought, oh shit, I wish there wasn't a fire alarm, wasn't expecting one, but I had to get out. And it had nothing to do with Trump other than maybe he was the trigger point. If he hadn't been the straw that broke the camel's back, there was going to be something else anyway, which would have done it. These are the exchange traded funds. China's off. Have a look. I did this for my clients earlier, but feel free to have a look at India, possibly Brazil, but have a look at India. I'm not going to do it in this webinar because I don't have the time. I'll do a separate one on exchange traded funds. Okay, markets year to date. Ugh. Well, again, I take the Buffett approach, which is great when they rebound up, as they always do, but nobody ever believes they're going to when it's down, other than the professionals. Then those are returns which will come back. and then some. The advantage I have as a private investor and you have as private investors is you can hold cash. Sadly, IFAs and wealth managers and pension funds won't let you and can't. So IFAs don't earn fees, okay, if you're holding cash in your bank account. So they don't ever want you to hold cash. They would rather you just kept losing money this year and in 2022. And they will tell you, oh, just keep holding it. It'll eventually bounce back. Obviously, by that time, you'll have made a 0% return and you'll have made nothing on the rebound up, which is when you want to be getting into it. You might say, well, forget rebounds. I'll just make my 0% over those 2 years, which is fine. Okay, make your 0%, keep paying the fees to the IFA. But with a tiny bit of effort, you could have just stepped out into cash. Okay, I lag. I don't pick tops. So for me, it was when I was in India over a month ago that I first said, right, we're going to have to get out. I didn't want to get out because we'd had such a good last 2 years. Like in 2022, I didn't want to get out because 2021 had been so phenomenal, and so 2020, but had to get out. We'll look at some of these. That's how they've done over 7 days and over the past year. S&P 500, where are we? Well, there we go. It's a daddy bear, as I've said, for those who've watched this webinar before. I'll answer your questions in the end. Wisdom Tree is perfectly fine, Boaz. Absolutely right. I'll come through some more of these questions in a second. The S&P, look, it's exactly like it was in 2022, and I didn't want to get out into cash then, but I had to because I didn't want to hold while this is falling, because being a cheapskate, I wanted to buy back cheaper. When they asked Warren Buffett, why do you like bear markets when prices are falling? He goes, well, I can buy good things, quality things like, say, the S&P at a lower price. Bang. Great. That's what I want to do. I just want to buy at a lower price. Why do I not want to hold on to it? Well, because then I'll get a 0% return when it bounces back. Whereas here, at least if as we did in 2023, get back in into it, then I get to make that gain. And I don't have the emotional disturbance here. A neighbor of mine met me yesterday and said, oh, God, it must be tumultuous for you at the moment. You must be really busy. And I said, no, why? Because the markets are falling. I said, yeah, well, I'm in bloody cash. So I want it to fall some more. The alternative would have been to hold on to it and be like Warren Buffett and then say, well, I'll just add more when it goes down here because I've got trillions in the bank. I don't have trillions in the bank. So somebody like me who's not as rich as Warren Buffett would get out of their cash. But if you were somebody like him who gets tons and tons of cash coming through your insurance business all the time to deploy, then you probably wouldn't even try and bother selling that. You would just say, do you know what? I've got tons of cash coming every single month. I'll just buy more cheaper later, which is what he does and what he says openly. Okay. But for somebody like you and me with more limited means, who don't have trillions sitting around in the bank, we would probably take our cash out of the investments and then add it in there. Okay. So I'm waiting for this to happen. Now, did I know this was going to happen this year? Well, I guess I should have done, but I was hoping it would continue going up because I'm human. But the computer said no. We don't rely on what Alpesh hopes and fears and thinks. We rely on what the computer says because it doesn't have emotions. Okay, I have emotions, can't be trusted. So when this was at this level, some of you have been watching this for ages, which was when? Around July time. I said, oh, well, we're overbought. I wonder if this is the top. This is the top. This is the top. And because it wasn't, we just stayed in until it became, like I said, look, it's looking like this. So it might have some legs to go. And indeed it did. I didn't know exactly when. I guess I could have said, look, it's going to be exactly at the same point. I really didn't think it was going to exactly mimic the whole bloody thing again, but it did. So I got out into cash. Why did I get into cash? And belatedly, not here, not there. I don't have the balls to get out then. Could have kept going up. No, until it was what I've called to you many times a daddy bear, which is when it's fallen through. What's a baby bear? A baby bear is when these prices fall, but the monthly averages are still rising. A mama bear is like this, which is when the monthly averages, when the prices are falling and the monthly averages, i.e. this, is falling but hasn't crossed below its own moving average, which is the green hasn't crossed below the blue. And a daddy bear is when it has. Okay. Now, what you'll really want to know, the astute ones of you'll say, hang on, this is a bit like poker. I want to know how much does that have to fall? In other words, how much money am I risking before I find out whether something's a daddy bear? And if that number is, as it is for Tesla, 50%, then screw that. No point using this on bloody Tesla. That's a bit bloody useless, isn't it? 50, I'm going to lose half my money before I find out I was supposed to get out. At that point, I'm thinking, well, what's the freaking point of getting out anyway? Okay, but if it's 5, 6, 7, 8, 9, 10%, that's not much to give up in order to find out, especially on something which tends to go up, to find out, oh, I should get out now. And is that really too much effort to make? If you don't want to make that effort, you don't have to. Just buy and hold this for the next 30 years, as Warren Buffett would tell you to do. I will be making it on this at some point. Obviously, we're out of this at the moment. It's not going to be now. Don't do leverage. Do not. I'm telling all of you on here, don't do leverage. It is irresponsible for me to say to any retail client to do leverage, because retail clients will absolutely destroy their mental health and their financial situation if they do leverage. So don't do this. I'm showing you what I'm going to be doing. Okay. Now, let's say this is where I end up getting in eventually. It won't be because this will probably fall a bit more. All right. Until it starts leveling up. But let's say it goes down a bit and then comes back and get in there at whatever that is, 1,700. And we go to 2,500. Okay, fine. That's going to be a 750 return on 1,750, which is about a 33% return. Okay, so that's going to be another 33% return, if my maths isn't too bad, well, closer to 40% return, and then some. I don't know when. It could be a year from now. It could be 9 months from now. I do not know. I do not care. Did I wish it kept going up? Yeah, but I stopped being a child about 50 odd years ago. Did I wish it would happen soon? Yeah, but I stopped being a child. Okay, so I'm not childish about it. Oh, mummy, I want my jam. Why can't I have jam? Why can't the market keep going up? Boo hoo hoo. It is what it is. The moment you start getting emotional, you should not be investing. I didn't say that. Warren Buffett did. I keep referring to him because the old man is just perfect on all of this stuff. Yes, that'll be another one. Not now. Certainly not now. And even if it went from here back to 3,000, well, that'll be 100% return. Okay, so even if this drops and then bounces up and I get in late at the same price it is today, it'll be 100% return. So why do you do it now? Well, because I'd be a flipping idiot getting in while that's falling. Why would I want to do that? I'd rather get in when it goes up a bit. Yeah, but you'd be late, Alpesh. You'd be lagging. Yeah, me and all the hedge funds as well. So it's fine. We don't mind lagging. We let the retail get in early. And it's good for the sale of Andrex. That retail gets in early because it ends up needing to use a lot of Andrex when it does. Occidental Petroleum, very popular with, again, the great Mr. Buffett. And I'm sure it'll be one we'll look at in the future. It's just not right now because those are still falling. Now, that might be the bottom. I don't know. I do not know. But until those start rising, I'm not playing that game. I'm not playing the game of, oh, let's get in early. You know, all the people who got in early, ask them, how did that feel when that became that? Doesn't mean it can't happen to us. It could. I just don't want to be stupid about it and say, oh, shit, I didn't have a process. Of course it was going to happen. No, I don't do it on charts. News and narrative, like Warren Buffett, I don't look at. We look at, are you late, Herschel, or slow? Value, growth, income, cash flow, Sortino, alpha, all of these. Did you miss all of this? Did you join late? Is the audio not working? Value, growth, income, Croaky, cash return on capital invested, all of this. If you want to invest based on news, it's called trading, gambling, speculating. Good luck. It means you want to follow journalists. Excellent. Think about what they do for a living. Oh, they're journalists because they're so good at their day job. Don't take my word for any of this. See what Warren Buffett says about looking at trading off news, or as he calls it, noise. It's not his accent. It's not he's misspelt it or mispronounced it. It's noise. Okay? Where people are putting their money, they put it into two places, into the stock or into the company. If they put it into the company, it shows up in the balance sheet, the cash flow, or the P&L. If they put it into the stock, it shows up in the price. Okay? Everything else is blah, 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 blah. Oh, yeah, no, I'm going to buy $1 trillion of Microsoft tomorrow. That's what Alpesh said, so it must be true. Because he said it, and a journalist wrote it. Fantastic. No, I'd rather see it happen on the balance sheet, the cash flow statement, or on the price movement. I want the truth. Has he actually bought it? No, he didn't. He said he did, though. That'll be enough. Okay, whatever you do, don't go to the market and buy some beans. Okay. We're trying to get to what's actually happening. So, NVIDIA, right? Falling, not for me. When that's happening, I do not want to be getting in. I don't care whether some journalist has written it is the greatest thing since sliced bread. I don't care if another journalist, and I can find you 15 who've written it's positive and 15 who've written it's crap. Okay. I don't care what the journalists are saying, and I don't care what the analysts say, because the academic research, again, shows, by the way, the academic research also shows that investing off the back of news. I mean, surely you looked up the research because people have done it, not just from Harvard, from proper universities, okay, that buying off the back of news doesn't give you a sufficient edge to be worth the while. You'll have looked at that because you're risking your children's inheritance or your old age pension on this, so you would have wanted to look at that. And the wonderful thing about the World Wide Web is it makes all this knowledge available. You know, we spend our time looking at TikTok dancing videos, though. So all that knowledge is widely available. So that's what you want to be looking at is, well, how useful was it? I've got a hypothesis. Let's look at the news. You don't have to do the experiment. Somebody else has done it for you. How did it work out? Okay, it doesn't work out well. So that's one. What does work out well? Well, we do know from the academic research that undervalued companies, profits, balance sheet valuations, tend to do better than overvalued ones. Growing companies tend to do better than ones which aren't great. Okay, so those are the things that you would want to do. Is this file on your site or private? Private. Eli Lilly, not yet. Again, these are going to be the ones which in due course I will, but not right now. And the turning point will be that. Why? Because the balance sheets, assuming that, again, value growth, income, cash flow, Sortino, and I expect those numbers will work out well. Now, I'm going to show you Tesla. Tesla's not going to be one I'll be getting into because it's just bloody volatile. I don't need the volatility. So this I'm showing you as an example of why can't you just bloody leave it alone? Just because it's in the news a lot doesn't mean you've got to go and catch it. Okay? I mean, you tell me. I don't know, private investors love it. Unless, I guess, you're going to hold it for 100 years until he lands on Mars, in which case, be my guest. But anyway, if I was looking at this right now, I'd say the biggest problems with it are, as a stock, it's very volatile. So whilst in the past, we've said, when was it? Was it down here? I can't remember. Anyway, when this was rising, I said, look, if you really want to do it as a momentum play, because it doesn't tick our boxes on value, growth, income, then just, if the green's rising, get in. If the green's falling, get the bloody hell out. All right, if you want to do that. I wouldn't want to do it. Sana, well, P ratio alone isn't good enough. You've got to weigh all the factors. If you only look at P ratio, then you're not weighing. You need to look at revenue growth. So with, say, the Mag 7, valuation is trumped by growth. So because they're growing at such a great rate and expected to and have done historically, the fact that their valuation might be conventionally considered high becomes less important. So you'd give a lower weighting to their valuation than you would to their growth, because the growth number is just that much bigger. So yeah, valuation becomes slightly less important for them. You'd expect them to be overvalued by conventional measures. Okay, and there's a couple of ways you can look at valuation. You could look at price to earnings or price to book. Warren Buffett prefers price to book. I don't mind price to earnings. And you could look at it relative to their historic levels, not relative to other companies, because what the hell does it matter to other companies? Relative to their own historic levels could be one way of looking at it. But you want to match that with growth. How fast are they growing? Which is why their valuations are that much elevated, and why, for instance, Citibank's valuation is pretty cheap. Okay, so what we do is, to save me doing all of that hard work, we just put it into an algorithm. Okay, and we chose value, growth, income because that's what the academic research showed. I'll show you one of the pieces of research which shows that, and you can just Google it and find it. It's very good. But that was the research which came out of Eugene Fama, Kahneman, and Thaler to some extent. Kahneman and Thaler were more on the psychology elements of it, and why people, basically smart people, make poor money decisions. Okay, so it's your Tesla. This at some stage, not now, not while the S&P is falling. I don't want to, but in due course, it'll be back in, and it is a 7 on our value growth income. Again, if you're one of my clients, I'm not giving the crown jewels away because I'm only telling them what will happen. Now, just because these stocks are much loved by hedge funds doesn't mean I plow in, but I can tell you where my money will be being made. And because of these recent market falls, there'll be some big gains like there were in 2023 and 2024. When? I don't know. I might have to wait a year before they come back in, but it will almost certainly be out of, to a lesser extent, these two. It'll be out of those. Now, you might disagree. Why not out of AppLovin or Flutter or whatever? That's fine. You can. I mean, I don't need to. It's like cricket. I don't need to swing for every single ball. Okay. I only need to go for the easy ones. Everything else, I'll leave alone. Okay. And the hard ones, why the hell would I stick my bloody bat out and knock myself out? It's just like cricket. This is from Goldman Sachs Investment Research. Average returns and length of S&P 1 year before and during a bear market, excluding 1998. Last year, bull market up 21%. So last year it was up 24%, by the way. Bear market down 32%. Doesn't mean it will. And then you got the volatile period at the moment. Boy, are we in that at the moment. That's where we are at the moment. Now, I don't know if that's going to happen and replicate again. What I know is I'm happy to wait. I'm happy to wait. Daddy Shill, if Alphabet's killing you, it's very simple. If you and I both agree for a moment, let's make the assumption it's a good company, okay? In terms of not just valuation, but growth potential. Okay, let's just make the assumption it is. There are 3 elements to making money and getting rich: time, return, okay, and risk or volatility, right? Okay. If you say I need to make 100% by tomorrow morning, Alpesh, with no downside risk, i.e. your time is low, your return is massive, and your risk you want is low, then forget about it. Because if I came to your house and said, listen, mate, give me £1 million, I'll return it tomorrow and I'll have doubled it for you, would you do it? No. So instinctively, you understand what I'm talking about. The problem with the market is that instinct goes out of the window for some reason when people come to stocks. So when they come to stocks, they go, shit, Alphabet's killing me because I thought I'd make 100%. And so I put too much money in. I put too low a time frame, too high an expectation on returns, therefore put too much money in and didn't realize what the downside could be in that time frame. So what do? Very, very, very simple. If we assume we like the company, you elongate the time frame. It's the only thing you can control. You can't control the return and you can't control the volatility. They're out of your hands. They're in the hands of the owners of Alphabet. The only one thing that's in your hand is time frame. You elongate the time frame. If it's a good quality company, you'll make your return and calm down as a result. Don't make the same mistake again of putting too much money in and not appreciating the 3 factors. Why is Warren Buffett 95? Why was Charlie Munger 100 years old when he died? Because they never sweated it, because they didn't need to, because they understood those 3 things and they just elongated. You know what they did? And he says it. He goes, I cheated. I just elongated the time frame in a market which always goes up over the longer term. It's just most people can't be asked doing that. Ravi, I think you're on here. Do you remember these medals we used to give out to my students for 100% stock returns? My job for my family is really simple. On the whole, 12-month holdings, though, some can be extended longer, like the Quality 5. And I'll have generally a 25% stop loss if I'm looking at specific stocks, which aren't in the Quality 5. But again, if it's Quality 5, then can hold longer and don't need to worry about a stop loss if it's a model portfolio, which I'll show you in a minute. And it'll be about 40 stocks, okay? Their minimum stocks will be about 15 that'll be held. And my job is to turn 10K into 100 into 1 million. That's it. Turn every 10 into 100 and 100 into 1 million. How long that takes is out of my hands. If there is a tailwind from the markets and no bear market in between, which is out of my hands, then it'll take less time. If there's a bloody bear market like 2022 and now, then it'll take longer. Okay? I can't do it overnight. I can't do get rich quick. It's not me. Can't do it. So this was Crocs. Ravi, one of your picks. I didn't pick this. Ravi got it off my database and he got that medal. He also got this off my database. I didn't pick that. And I didn't pick that. It was on the and that was a year when he got far better performance than I did because the ones I selected, I mean, this just shows you if everything's got green and I pick a bunch and he picks a bunch and mine didn't quite do as well as his, then he'll do better than me. Fantastic. Well done. But this is the most useless profession. Okay. If ever you do make lots of money on it, this is something I used to put up before and I've forgotten to put up for a while. I'm co-chairman with Lord Billamoria of the Lombard Trust. So if ever you get flush with capital, and I've been posting these, and we've had 1 or 2 students who generously have given as well. Anyway, do connect with me on LinkedIn. We're not finished. I've got a load more stuff coming still, but do connect with me on LinkedIn. Connect as in follow. If I don't know you, or only clients I'll connect to, but you can follow because there's some useful articles on there. A lot of useful articles, tons of free resources on here for improving pensions, and lots of free resources from including my book and so on. One of the things I try and do, it's very simple, is look for stocks which are like this. Okay. Now you might say, what the hell are you talking about? And it's something which also, again, the great Mr. Buffett tends to do, which is why he has so few. Very few companies look like this, very few, sadly, where their returns over a 250-day period will exhibit this kind of a distribution, i.e. positive, albeit with a low probability of being positive. Most will be negative, okay, at this end with some kind of probability. They'll look more like this over 250 days. So if I know historically my stock tends to behave more like this, then this, when this happens after 20 days, doesn't bother me. When it drops 14% after 5 days, it doesn't bother me. Okay, if it drops 50%. So why am I in cash at the moment? Because I'm a bit greedy. Well, what? You're greedy and you're out of the market? Yeah, because I think I can buy things cheaper. Let's say I stayed in. Then I know over the long term, it'll still be all up and it'll be fine. Okay, I'm going to show you some model portfolios in a second, okay? And I'll answer some of these questions in a second as well. Okay, so which stocks are like this? Well, my quality 5, and I mentioned Microsoft, for instance, as one of them, even though in the last 12 months, surprisingly, it didn't generate the kind of phenomenal returns it's done for me for the last 10 years. But that's fine. It'll come back because in that time, it had a 0% return. It's gone and doubled its profits, doubled its cash pile, doubled its balance sheet, or thereabouts. Okay, and yet the stock price didn't move. What a no-brainer. No wonder the smartest brains will be piling into it at the right time, not right now. And it's easy. They pay you the big bucks for mentioning freaking Microsoft. Yeah, I'm afraid so. But not right now. Where are we at the moment? We are here. Okay? We're not at 1. We're at 1 for bloody ages. I didn't know when 1 was going to end. We were at 2 for a while, which I didn't know really was going to be the start of 3. But we're at 4. And as long as we're at 4 and we're not at 5, I won't get in. When we get to 5, I can edge in. Now, you might say, well, I don't want to do that, Albish. I want to ignore all of this, and I just would rather buy expensive. Well, you can either buy expensive with both feet, go in right now. But again, as the great Mr. Buffett says, don't test the depth of the water with both feet. But it's up to you. Equally, you might, as somebody said earlier, dollar cost average. At least that's better than going in with both feet. Feel free. If you're cheap like me, then you'll say, yeah, I think I want to eke it out a bit before I buy some money. And that's, again, Mr. Buffett. $3.50 each morning to go buy a breakfast at McDonald's. That man is cheap like me. Edge in, yeah, DCA. Well, you can dollar cost average, or I prefer adding to winners. So let's say I put 10% of my money in this month. If a month later I'm up, then I might do it again, but probably not if it's cheaper, but you can do either. The dollar cost average is, again, as I say, somewhat discredited by more recent literature, and adding to winners is what the hedge fund industry tends to do, as exemplified in my book, The Mind of a Trader. I don't do anything unless I've got the research on it. I mean, it's my money. Unless I've got the research from the best brains on it. Why should I make a decision based on my thought process? I don't think I'm that clever. I think the Nobel Prize winner Eugene Fama is a bit cleverer. I think Bill Lipschutz, who I interviewed for my book, Mind of a Trader, who was global head of foreign exchange trading, is cleverer than me. I think everybody I speak to better be cleverer than me. Tom Singer, who's one of the early investors in my hedge fund, the founder of New Look, said, I asked him, what's the secret of your success? He said, I just hire people who are cleverer than me. I do the same. Everybody I follow, definitely cleverer than me. Okay, otherwise, what's the point? It seems really obvious, you know. Why should you have capped your ceiling at your own height? Why not stand on the shoulders of somebody who's taller? I mean, I don't know. It just seems too bloody obvious. So that's where we are at the moment. So let's talk a bit, before I show you some model portfolios we've created, how fund managers destroy your wealth, for those who don't know. Well, first of all, Nobel Prize winning research shows that fund managers are crap because they spray and pray. They don't go into cash during falling markets. So at the moment, Fundsmith, like 2022, is losing your money. St. James's Place is right now, like 2022, losing your money because they're not in cash. I am. Okay. Scottish Mortgage Investment Trust lost 50%. So did Blue Whale lost 33%, I think it was, in 2022, and Scottish Mortgage Investment Trust 50%. They're losing your money right now. Okay, let alone that they are restricted by geography, by style or theme. So you've got a lot of reasons why they're rubbish. So yeah, I've got an unfair advantage. Like Mr. Buffett, I can buy what the hell I want, and even unlike him, I can hold cash if I wish. You don't have to hold cash if you don't want to, if you're impatient. Of course, they've got their fees. They know you won't leave. Who the hell leaves? People can't be asked, and they rely on that. I mean, when was the last time you changed your bank account, for instance? Fund managers tied to a style or a geography. They're tied to relative performance to an index. So here's how they cheat. They say, oh, we're benchmarking the FTSE 100. So they look at the FTSE 100 and the constituents, and they say, right, how can we beat this? Because all they have to do is try and beat it. So they go, well, let's add a bit more than the FTSE has in this stock, and a bit less in these two. And then let's bugger off to the ski slopes. Most funds have two managers. Okay, a shitty underling who's fresh out of university and can get paid less than 100 grand, and somebody who's old and they just can't sack. Okay, who's a bit older, and both have gone to the right schools, universities, and with the right qualification. I'll tell you now, I've got more qualifications than any of them, and they're shit at their job because they're restricted by these things. All right, I don't just say it, they say it. So what's the advantage of the private investor? Well, private investor could, if they can be asked, could go into cash. Well, let's say they don't. Then they could say, well, I won't be restricted by geography or only picking undervalued companies or only being tied to an index. I'll look for absolute returns by looking at 10,000 companies, which can go in my SIP or ISA, and undervalued high growth ones. Why don't fund managers actually do that? Well, because then they'd have to have one fund, and then they couldn't earn enough money because they're greedy bastards. Think about it. Their job is to market to get $1 trillion under management because they get paid a percentage of assets under management. If you're maximizing assets under management, you can't just have one fund because you'd have a $2 trillion fund. You've got to say, well, we better put some in a UK growth fund and a Japanese this so they can sell you more and more shit. Fund manager is rich, paid either way. Anyway, the rest of it you know. I'll give you an example. Now, here's one. I haven't shown this for a while. This is one when we first launched this. We launched the Great Investments Program. IFA fund manager handcuffs, so you're going to be brought right. So this was 91. We showed one of theirs. Okay. And how over 3 years, great. 3 years minus 2.3%. 3 years minus 2.3%. Over 3 years, not over one. Okay, if it was over one, even if you're down 10% over 1 year, I'd forgive you. You know, I don't find out to go into a daddy bear unless I've lost about 10% from the peak of the market. So if I look at my account and say, oh, look how much money we've made, I've got a discount at least 10 to 15%, if not 20% off that before I know what's in my pocket, because how do we know when to get out? If we get out. Okay, so anyway, what they'll do is they'll have these diamonds and these letters and these numbers out of 10, and they'll call it booster, and they'll be pretty shit. Let's look at a model portfolio. So we created a model portfolio. We said, what if we took our filtered list at the peak of the market, which was February? Okay, so right at the top before the market fell. And what if out of the filtered list, we took the highest volatility stocks? Because based on people's appetite, we have low and high volatility, like here. We can rank it by volatility. So some of the students who are in their 20s might want higher volatility. Some who are more pensioners might want low volatility. So what if we pick the worst possible time in the possibly worst stocks, but which still ticked all our boxes of value, growth, income, cash flow, Sortino, okay, in February, right? Then what's the absolute worst that could happen to us? And that portfolio anyway would only have ever been selected by people who were more risk loving because the volatility they knew. They didn't know the market was peaking. We didn't. but the volatility. So let's say somebody who really likes volatility. So we looked at that. We said, well, what would that actually have meant? What does it look like? And we said, right now in February, where I'm talking to you in April, obviously, but in February, the peak of the market, before it all fell, not now, but in February, they were ticking all our boxes. Okay, so we're happy to have held them because they look better than they've done at any point in the last 5 years. But let's look at how they performed up to that point in the last 5 years when they didn't look as good as they actually do in February, for God's sake. Okay, and this is how it looked. All right, this is what happened. They generate 31% per annum. In the preceding, what is that, 4 years, all right, in the preceding 4 years, it was 31. That includes a bear market of 2021. We're assuming you just held it. The volatility was 25%. Like I said, it was high, so it's not suited to everybody. Drawdown meant 35% because you didn't get out at any point. There were no stop losses of 25% stop losses. There's no daddy bear rules. You just held it, i.e., you did the absolute worst. And we thought that portfolio now looks better. So in February. So if we were still holding it, we didn't use the daddy bear rules, then I expect in the next 5 years, that'll continue generating 30%. But that's the volatility. That's the problem. Most people can't handle that. So don't even bother looking at it. Okay, don't even bother looking at it. By the way, it was 58%, 59, call it 60% of months were positive. Okay, so 6 out of 10 months it was up, 4 out of 10 months it was down. Right, that's what it looked like in terms of the stocks that were in it. And you can see, okay, you can see there's some bloody big drawdowns. Imagine 30% per annum, because we picked the highest volatility one, got you drawdowns over the last 4 years of 65% drop in one stock from peak to trough. So that imagine you picked it at the worst possible time, you lost 65% of your money. But you still got 31% return in your portfolio overall. That's portfolio engineering, portfolio construction. Okay, mixed volatilities end up giving you a better reward to risk ratio. Look at how bad those are. Well, we said they're high volatility. Look, we purposely pick things with high volatilities. Look at those volatility standard deviations off the roof. Okay, 45%, 37, 35. Best years, forget best years. Worst years. Some were down 37, some were down 31, but that's what it generated. Okay. And in February of this year, at the worst possible time, before the market fell, it looked better than it had ever done in terms of those companies' value, growth, income, cash flow, Sortino, Alpha. All right. But that would be suited probably for the person we created it for in their 20s. Okay. It'd be suited for somebody in their 20s. Let's say you went with something a bit more conventional. You only did half as well as that because you said, mate, forget it. I want you to reduce that from 25% to 12%, and I'm happy to take a 15% return in exchange. So let's halve all the numbers because it doesn't give you a bloody heart attack. Then what happens? Let's say you plan to invest over 15 years, not in the same portfolio maybe. Well, maybe you do. Okay. And let's say it gets to 20%, some years more, some years less. 10K, and you plan to add a bit into your pension, because why wouldn't you? That becomes 600K. That's what it looks like. The biggest problem are these years. Why? Because initially, and this is why people give up and why Buffett is so rich, is because it gets exponential at this age. But who can be bothered waiting? Listen, cinemas to go to, holidays to go to, Dubai is calling. All those EasyJet flights don't pay for themselves. Restaurants, you're young. Dinners, Michelin star restaurants, okay? Cars to buy. Ladies or men to date. Wine, women, and song. Who can be asked? 7 years before you even notice anything compared to the contributions you had. Barely notice anything. That's why most people don't do it. You've got life to live. Got life to live. Okay. Keith, sold my company and got in 2022, missed the boat, thought it was a blip and pretty much lost last 2 years again before I got out. I'll be paying more attention now. The risk appetite rule. Keith, honestly, the risk appetite thing is nuts, but also think about it. It's our pensions and our life savings. Why not learn a bit more about it? I'm going to show you something else. So I put this table together over Easter. Let me explain what this is. And this is really important. Probably say it's one of the most important slides I'm going to show you tonight. This is annualized return. Imagine these as hypothetical portfolios. By the way, some of these portfolios are impossible. Clue 21. Portfolio 21. Ain't going to happen. Einstein can't create that portfolio. So annualized returns, 10%, 15. These are their historic. Doesn't guarantee it'll happen in the future. 20%, 25, 30. You just saw a 30% one, and you saw necessarily there was high volatility. I wish I could get a 30% one engineered with a 10% volatility. If I can do that, I will be the Elon Musk of rockets and SpaceX. Ain't going to happen. Nobody's done it in history, just so you know. Okay, Alpesh, you'll be the first. I wish. Ain't gonna happen. All right. If you got a 30, as you saw, you're closer to this 25% volatility, I'm afraid. All right. Whatever that return is, you're probably going to be closer to it on volatility. So what is the point of me showing you this? What I'm showing you is how long does it take to double the money, right? If you've got a 10% return, it takes 7 years. So we don't want 10%, do we? 15% is the S&P generally. So it takes 4.5 years to double your money. So if I can just eke out a little bit better than the S&P, I'm taking 3.5 years. That's nice. 25%, that's how it gets sexy and interesting, but my volatility is going to increase. How do I, with an increase in volatility, how do I ensure I'm not going to panic? A, by seeing historically what's happened, okay, so that I know, oh, this is a bumpy road. This is not going to happen. It's like live fire training in the military or flying blanks for training. So I know it's going to happen. When you don't know that this is going to happen at high volatilities, that's when you panic. Okay. And the second thing is you elongate your time frame. Those are the two best ways, knowing what's happened in the past and elongating your time frame to be able to get to that. You cannot get to that, because I'm going to show you why, if your expectations are too high and you don't know what's happened in history. Because look at this, probability of being down after 1 year, if you've got that volatility and that return, 12%. After 2 years, 5%. There's still a 5% probability after 2 years you'd be down. And you might think, what? But historically, I've always doubled my money in 2.7 years, but I'm down after 2 years. How am I going to do this? This is the maths people don't understand, and that's why they panic. Okay? And that's why they could have something good, but they mess it up. I know it's a bit complicated. The two mistakes of retail investors: exiting due to panic or boredom, when and if they've got quality portfolio. When they've got a shit one, I couldn't care less what they do. Okay, well, hopefully they'll exit. These are the two reasons. And I'll give you an example, right? No plan equals no clue equals panic or boredom exits. Here's a classic example I show my students. 9 months out of 12 months in 2021, Microsoft, okay, had no or negative returns, but actually was up 50% that year, right? It was up 50% in 2021. This is 2021, all right? It was up 50%. If you look closely at this, and feel free to pause the video, for 9 months, it had 0% returns or negative, right? Guess what most people would have done? And it went up 50%. Let's say you put all your money in that. In 1 year, you would have got 50% rise in your pension. You wouldn't put it in one stock, but boredom and panic. They either panicked when it fell, which you would do if you put all your money in just that, because sod's law, you would have got in there. Or they got bored, well, never going to happen. Look, I got in, Alpesh, but look, after 6 months, all my money's like, I'm back to where I started. What's the point? Well, it's gone up again, but it's gone back down to where I was. So I'm back to where I was 6 months ago. These are the common things they'll say. This only works with quality companies. If it's a rubbish company, you should be out anyway. One of the most important things we do with clients is to work out their personas. Are they warriors? Are they constant observers? And this is a dangerous personality. If you are a constant observer, you should be having low volatility exchange traded funds. Don't try and change your personality. It's not going to change. All right? People change who they are for 5 minutes by 5%. So don't bother. All right? Most want to be this guy. They want to be the mixed user. Hardly anybody's relaxed, which is fine. Okay. Warrior, some of them. But basically, if you're this, ETFs, if you're this, then probably one of the model portfolios and the quality fives with the Daddy Bear rule. Okay. I tell them, easy flow chart. This is how you get a plan. Easy flow chart. Flow charts, make your flow chart beforehand. Feel free to copy that one if you wish. Make your flow chart beforehand. Because when you're in the battle, you do not want to be using emotion. When you've got a plan beforehand, you're calm. It's fine. Now, plan B, hold and do nothing. Make sure, as Warren Buffett says, the quality of the company is such that if they switch the stock market off, you'd also be, as a plan B, willing to hold it for 5 years. The biggest problem private investors have is they buy shit companies because there are so many of them. There you go. None of these meet our criteria. None of these meet our criteria. That's your biggest problem. But boy, is there a fund management industry willing to sell you that shit. So we then looked at the S&P 500 and which ones had the best Sortino. Remember, highest average return historically, lowest downside. Now, I wish I could have got a volatility lower than 17.5%. But this is just to give you an example of medium risk. And I couldn't. 17.5%, best I could engineer. I'm sure I could if I did a bit more mathematics on it. I've got some clever people. Well, actually, I've got some clever people who can use clever tools. It's the tools that are clever. That return is 26% per annum. Doesn't mean it's guaranteed in the future. Okay, and that's including through a bear market of 2022. Okay, drawdown 16.1%. That's not bad. As long as I know I could get a 16.1% drawdown, and I assume it could be a bit worse going forward because Sod's law. All right. But I can live with that if I'm getting that. But I can't get that in 1 year. I'd have to hold this for 5 years to get my 26% per annum on average, I reckon. Because it's a bit like saying, here, you've got a coin, toss it. Is it going to be heads if you just toss it once? No, 50-50. But if I toss it an infinite number of times, give it enough time, yeah, half the time it'll be heads, half the time it'll tail. So in other words, if you elongate the time frame, I'm likely to get closer to the longer term average, even though the past doesn't guarantee the future, and that guide of undervalued stocks, etc., that we filtered from the portfolio works. Anyway, the reason I don't like these kind of people is because they won't do that. We know they won't do that. As I said, Eugene Fama got a Nobel Prize in economics for proving it. They earn too much money in fees for not doing any of what I've just said. Right, so why should they? So these are the filters, just to give you these. Valuation, there's many ways to work out valuations. My favorite is probably these two, but if I had to choose one, it's that because of the academic research. And I'll show you some of the research we rely on as well. There are these other methods. They have their pros and cons. Warren Buffett prefers price to book. But as long as you've got one, and you want to give that about a 40% weighting, because historically, according to the academic research, that's what it is. Growth, sales and earnings, income on there is dividends. Now that's only a 10% weighting. It's really less important, but it ensures that if a stock drops too much, its dividend yield rises and therefore the pension funds come in. So it gives it a good cap to a stock. Okay. Revenue growth is good. Growth is important. We know it's been a very critically important person. Momentum is more important than people think. They think it's a dirty word. Oh, you looked at a price chart. Oh, you must be a bit of a dick. Well, actually, the momentum-based hedge funds are the biggest in the world and they're the richest people in the world. Take Jim Simons and his momentum-based sub-funds, okay? Winton, AHL, Aspect, a lot of the Brevin Howard funds as well. So momentum, because we know trends tend to persist. We're not going to look at chart patterns. We're not going to look at media. Stochastic, less important, more the trend and recent prices. And we want to weigh that pretty heavily as well. Statistics is important because it tells us what's been happening. Okay, it's cheating. Okay, is the company producing a high Sortino, high average return, low downside volatility? Does it snap back really quickly if it falls? Historically, does the stock price tend to snap back? In other words, is it the kind of company that has a lot of dip buyers who are pretty quick to move in? That's what the Sortino is showing. Ideally, we'd use something called the Omega ratio, but it's probably more sophistication than we need. Okay, if I was managing trillions, fine, but I don't think I need to be that sophisticated. You can Google it yourself, but I think Sortino is clever enough. Comes from the hedge fund industry. Anyway, that's really good research. It's something we used for it, Tweedy Brown's research. Because guess what? And this is the bit people don't realize. What's worked? Studies of investment approaches and characters associated with expected return. Associated with exceptional returns. You don't think people have been researching this shit? We're talking money to be made. You don't think academics get paid a shitload of money to try and work out what's going to work and what isn't? You don't think that stuff's been produced and distributed? Do retail investors look at it? No. Guess what they look at? Narratives and stories. Stories sell. Data doesn't sell. Stories sell, sadly. Okay. I've been writing about this for donkeys. That's my column from September the 11th, 1999. Okay, yes, and what's more, they should probably sell up their entire UK holdings and buy only US stocks. I have been shifting virtually all my long-term holdings from the UK into US stocks. 1999. That was my first column in the Financial Times. You tell me, how's it done in the last 26 years, the US market compared to the UK? But there's another problem with that. I didn't do that because I knew what was going to happen with AI or anything else. It was choice. It's because I could sift. It's because I could sift. I had more. I had 10,000 to choose from. That's why. I didn't do it because I thought the UK is not going to do as well as the US, although that had a lot to do with it. American stocks outperformed their UK counterparts. I published it 26 years ago. But will people listen? I think some of the fund managers are now gradually starting to. Well, there you go. Here's a little clue. Asda or Walmart. Solution 1. I can give you the ingredients. You make your own cake. Okay, so you can create this yourself. Yahoo Finance, I think, probably let you do value, growth, income. Make sure you got value. Make sure you got growth. Try and do Kroki if you can. Sortino Alpha. Or solution 2, I'll show you a ready-made cake for your appetite. That isn't going to be the appetite of most people. That is, I think this is Lucas. So Lucas is a Royal Marines commando on our program. He's in his 20s. That's the commando one. You're not going to do that. All right. I can do that because I'm old and experienced. Okay. And I can handle it. Most people will want half of that, probably to start off with 15%, 12% there, then gradually migrate to 20 on there and try and keep this at 15 or 18. That'll move to closer to 18 and keep this at 20 to 25. Okay, and keep those drawdowns below 20 because that's what scares most people. Okay, and for most, they'll start off with an exchange traded fund portfolio, so the drawdowns are really low because funds tend to be lower risk. And if you're confused, just buy an S&P index tracker. Nothing wrong with it. All right. So what happened in 2024? This is the high risk end, right? So I'll just show you the high risk end, not the ETF type, taken from the approved list of January. Okay, that's what it looked like. That's volatile. But then that's what you get. Thank God we did, because this year looks like it's going to be holding our hands. We don't have to be smarter than the rest. We have to be more disciplined. We just have to have a process. I'm nowhere cleverer than anybody else. I just have a process. Okay, I'm going to start answering your questions. By the way, this is from Goldman Sachs Asset Management. When we replicated this, we misprinted retirement. That's our fault. But this is from Goldman. It's not their slide. It's their information. We've recreated it. And you can work out where you are on this, okay, based on your years to retirement. So if you think you've got no years to retirement, you probably want to be holding a lot of cash, okay, and equities might be as little as 20%. Well, at the moment, for me, I'm totally in cash, and I'm not retired. And if you're at the high risk end, i.e., you only want equities as opposed to any exchange traded funds, okay, then you probably want 20 to 40 equities. And you also want to remove market risk in a daddy bear like now, because you're already at the high risk end. If you want to be lower risk, you want a model portfolio, which is exchange traded funds. Go there for more stuff. All right. We also look at what the hedge funds own. I've got to do this for my students tomorrow. I'm going to show what some of the 40% per annum hedge funds have been, who own. What do they own, and see if any of those meet ours. My job partly, yeah, in a way, is to try and work out by when can I double my money. If there is a bear market, it might take 5 years. If there isn't, it should happen in under 3.8. It just depends whether there's going to be a bear market or not. Why 5 years? Well, that's the bloody S&P. If I can't even do an index, given that I also invest in the index on leverage and use the daddy bear rule, then I should at least be able to do that, wouldn't I, unless I fall asleep. But there's another reason. 2-year average rolling return is 32% per annum. 32% per 2 years. And that happens 88.5% of the time that you get a positive return. So there's another reason why I've got a tailwind. But like now, we've got like 2022, we have to hold cash. Okay. Either you want the cake made for you or you want the ingredients to make it yourself. What we found is when we give the ingredients to novices, they often get their risk appetite wrong and they're overambitious. So it's far better that we've realized now they start off with a ready-made cake with exchange traded funds instead. Have a read of those as well. Very easy to open SIPs and ISAs. Don't have to use Barclays. Anybody, you just go online and do it. This is what's going to happen this year. See that in 2022 when these pension managers like Scottish Mortgage Investment Trust just held on to people's cash as the market fell. That's what's going to happen again to the likes of Fundsmith, to St. James's Place, and all the rest of it, because they can't hold cash, and they're not holding your cash right now. And you might want to ask them, why the F are you not holding my cash? If you want to join the program, I take on 10 people at a time on the webinars, and you get a webinar discount as well. Okay, and it's a one-off cost. We don't do subscriptions because otherwise there'll be a conflict of interest. If we did subscriptions, I would be getting paid as a percentage of you staying on, and then I couldn't tell you to hold cash because I think, oh shit, they're paying. Why would I tell them to hold cash right now? Okay, and that's what it is. If you want to be part of the program, I'm going to answer a load of questions now. Sandeep, Alpesh, you mentioned Indian stocks. Do you have analysis for those? No, I mentioned the exchange traded fund for Indian index. I don't do Indian stocks individually. So you'd say past returns are good at assuming future returns, or SD of a stock standard view? No, I'd just say the past is some guide, just as I'm sure how you behaved yesterday is a guide to how you'll behave tomorrow. It's not a guarantee, though. Sorry, second question. Is the MACD now too slow of an indicator to keep up with Trump tweets? No, I don't think so, because it's gone through a lot of shit, and Trump's only one piece of noise it's gone through. Is a mix of NASDAQ and S&P index trackers a good general mix for a pension investment? Roger, no, because I don't know you, and it seems like you're about to take on a lot of volatility. Unless your ambition is to hold it for 10, 15 years, then yeah, Warren Buffett would say, if you're going to hold it forever, S&P is fine. But for all I know, you're a 70-year-old man who's about to get into the S&P and it drops 25%. So not good for a pension, no. If we do our due diligence and leave a safe lag, how come you still think 2x leverage is too risky to advise? Sorry, Sam, because I don't know you. That's why. It's the most sensible thing for me to say to a stranger is don't do leverage. Imagine I met you at a bus stop. How could I say to you, yeah, go into leverage, mate, you'll be fine? Okay, that'd be nuts, wouldn't it? That'd be nuts. So that's why. Let me answer some more questions. We've got quite a few coming in. Hi, Alpesh. Would you sell if the MACD line fell below the signal, even if the MACD's peak is well below its previous peak, i.e. not from an overbought position? It's a good question. Let's leave the hypotheticals until it actually happens. Okay, are all stocks a good bet like Exxon? At the moment, I don't do betting. So, Peter, no. What you're talking about is gambling and speculating. I'm talking about investing. So, from my data, no, not at the moment. I showed you Occidental, and that was one of the reasons why I showed you Occidental. Okay, now let's go earlier into some of these. Sold my company. Oh, we did that. Carwin, we should all print out and frame your chart Alpesh, stages 1 to 7. Thank you so much, Carwin. You know, one of my jobs, which people don't realize, is to inform people, communicate to them the information in as simple a way as possible, and that chart was one of it. Sean, DCA, does stepping out and stepping back in MACD outperform DCA? Has done for me, Sean. Edge in DCA, yeah. Okay, how do you access growth for a company? Are there any instruments in TradingView that show growth? Yahoo Finance, I think, will give you some information on revenue growth. Okay, Kishan, is there a relationship between weekly and monthly MACD? Can you use weekly to determine when to get in or out, or is it too volatile? The way I do it is the way I prefer you did it. You can experiment by just looking at it if you wish, Kishan, but yeah, weekly is more volatile than monthly. Similarly, daily is more volatile than weekly, and you'll end up trading your investments. Don't trade your investments. Those joining, thank you on that. If you can't get through, that's a backup site, and the don't forget to use the coupon for the discount on there. Alpesh, would you sell? Oh, I think I've done that. Yeah, Ben Dover, seriously. I always buy high and sell low. Oh, Ben, you are such. I think you meant that seriously. That means you're emotional. Raheem, hello, Alpesh. Key question for me: is it time to get back in and dollar cost average? Not for me, as I've explained. I think yours came in really early. Weekly seems to be turning upwards. Yeah, so what? Well, exactly. You just said it. Monthly's falling. What does it matter? Staz, hi, Alpesh. Thanks for saving my portfolio from minus 30%. What do you think about dollar cost averaging from this point? God, everybody's just so impatient to get in. Well, I'll put it this way. Okay, because I think a lot of you are desperate to get in. If you've got FOMO with the market, why don't you just put 10% of your capital in okay, and see if you get buyer's remorse. Then wait a week, 2 weeks, see if you want to put more in, okay? You don't have to dive in with both feet. Let's say you're looking at a raging river in front of you. Put your toe dip. When you go to the beach, what do? Or the pool, do you just dive in at the deep end and go, oh shit, that was cold. I didn't realize how deep it is. Come on. Oh no, but I do that with my pension mate. Do you know people take more time deciding on a washing machine than they do on putting an offer in for a house? Tells you everything you need. There's a great book, Why Smart People Make Stupid Money Mistakes. It's something like that. Sam, otherwise no better than the average person. People are addicted to short-term gains. They are, Sam. It is crazy. Fight the news. I agree. News is great if you want people to gamble. Spread betting firms have a very simple rationale for sending you as much news and information as possible. The more they give you, the more you're likely to trade. The more you're likely to trade, the more money they make. Okay, it's really simple. When I am reincarnated, I want to be a spread betting broker. Okay, why people trade their investments? They're not. People are innately gamblers. Okay, Warren Buffett says, if you don't look at the stock market at the weekend because it's closed, try not looking at it during the week. Listen to the man. Don't listen to me. Listen to Buffett. Everything I've told you follows his principles. I've just put it into words and numbers. Better to be out wishing you were in, exactly, than wishing you were out. Yeah, exactly. I'm out at the moment. I'd rather be out wishing I was in than in wishing I was out. Absolutely, completely agree. Okay, any questions that I haven't answered, let me know or email me. Thank you all. I'm so sorry I've overshot on this one. But like I said, I hope you like the information that I'm giving, and let me know as well. And I will send a repeat out or replay. It'll be on alperspatel.com/links. Also, don't forget, sorry, it'll be on alperspatel.com/latest shares, one of the links you had here. But if you want the links here, it's over here as well. What does it mean, 40% webinar discount? Is it 14K off the full price? No, if you go to Stas, if you go to alperspatel.com/shares too, it's on there with the embedded discount. That might be easier. I'll just send you that now. If it's not clear, just email me and happy to help anyway. And Paresh will give you a tour. So if you want a tour, if anybody wants a tour of the Great Investments Program, just email Paresh at tradermind.com. Okay, congrats to Leeds. Well, I'm not sure, Minesh. You know what? Next season, we're going to, hopefully, we'll keep, the Americans will keep putting more money in. Mohammed, thank you so much. One last question. How long do you think the volatility will last due to this administration in the US? We don't need to worry about it. So I don't know. Okay. It's, let me put it this way. Don't worry about the things you don't need to worry about. I'll put it another way. If you ask me, do you think it's going to rain tomorrow, Alpesh? I'll be just as qualified to answer that. Now, I can give you some kind of intelligent guesstimate, but it's not something we need to worry about. I want people to stop thinking about things they don't need to think about. And the reason I say this, again, it comes from the Buffett mindset and mentality. Thank you, Sean. Indeed. Are these webinars repeated? Yes, the repeat and replay will, give it about half an hour, will appear on alperspatel.com latest shares. Okay. But give it about half an hour for all the uploading to happen. Thank you all. I trust there was nothing else. Thank you, Mohammed. It's amazing how much people overthink, but we know this in life generally as well. Okay, thank you all, and thanks for joining up on this. Any other questions, feel free to keep them coming. Going to share some files, as I always do. I'll send a copy of the book across. Let me know if at your end you can see a number of files showing up or just one. Hopefully there should be lots, including the book, Investing Unplugged, my book on investing, which has had some wonderful reviews. So do have a look. Thank you all very much. There you go. That one has this and this and this, all sorts of stuff for you there. All right. Thanks, friends. Thanks, everyone. I'm going to get a late night into bed. Here we go. Thank you. Just me now.